Okay. Well, hello everybody. This is Atisha. I hope your week is going well so far. And as announced a bit earlier today, today's topic is one that will be of particular interest to those of you who are business owners, perhaps real estate investors, especially those of you who are contemplating incorporation or already have a corporation, perhaps are working with partners, whether money partners or active partners. Oftentimes in the course of doing business, you're going to be working with partners more often than not in the context of a corporation. So today's topic will be particularly relevant to those of you who are entrepreneurs, real estate investors, and so on, other types of business owners. The gentleman joining us today, Mr. Jack Zwicker, has been with us today, has been with us on another session before talking about wills and powers of attorney. Jack is an experienced Toronto area lawyer with spanning a 40-year career in the areas of real estate law, estate planning, and Jack, you can tell us more. You also do corporate mediation and arbitration, a well-accoladed lawyer and professional. So thanks very much for joining us today, Jack, once again. Nice to have you.
Okay, my pleasure.
Your camera all of a sudden got a little bit out of focus. I don't know if there's anything you could do about that.
No, it's okay here, so.
Okay, no worries. Anything to add to my little bit of introduction, Jack, and maybe speak a little bit about today's topic, because I think to a lot of business owners, the idea of a shareholders agreement is again one of those buzzwords that business owners know that they have to put together, but they don't really know what it covers, what it's all about.
Sure.
Yeah.
Okay, no problem. No, just in terms of bio, I semi-retired about 2 years ago after 42 years as a lawyer, real estate, corporate, commercial, wills, estates, and litigation. That's on the business side. I've also done extensive work in what's called dispute resolution. The little tag phrase for it is A like Albert, D like Donald, R like Robert, ADR, which stands for alternative dispute resolution. And that is geared to people who don't know how to negotiate and need help with their negotiations. Mediation, where you need a third party to help you mediate a problem between at least two others. And arbitration, if you're looking for somebody to make a decision like a judge would, right? I've also been a judge for 7 years at the small claims court level. And so there's a lot of experience that tailors into what we're going to talk about today. I flipped a quick email to Letitia minutes before, so she may have been busy doing all the technical stuff to get going. She may or may not have seen it. And that was an email that was a response to a comment that she had made when I spoke to her this morning about partnerships. And okay. The minute I heard the word partnership, my hair stood up, okay? And I'll go through this now. There are basically three ways of running businesses. And I'm going to use Albert as an example. There's no Albert, I'm just making it up.
Yes,
I like A and W, so Albert, and the W is Walter, right?
Okay.
Let's assume Albert is running a small business. He doesn't have any people around him. He may have employees, but we're not talking about that. And he's by himself. So Albert would be, to use lawyer's language, unfortunately, a sole proprietor. Sole, for alone, and proprietor, owner. Okay, so a sole owner. If Albert meets Walter as an A&W and they say, hey, why don't we partner up? You can have a partnership. Many people do stuff. Unfortunately, people are in a rush. They don't write things down, and it's a nightmare for the lawyers, and it's a nightmare for the accountants, and it becomes a nightmare for them when everything goes wrong. And usually it does, right? So if Albert and Walter get together as partners with an agreement or without, they're a partnership. So partnerships 2 or more. Could be 3, it could be 30, but 2 or more, at least 2. The third format is a limited liability corporation. Sometimes people stick the letters LLC on it. I don't care about that. A corporation's a corporation. Primarily what I want to deal with today, because we only have an hour, is corporations. But I'm going to start off by saying if any of the people who are participating, who are listening to this webinar today, are in a situation where they're on their own, sole proprietor, or they're like Albert and Walter and they're either in a partnership or looking at a partnership, there's dangers with that. And there's also disadvantages, right? where the dangers are and the disadvantages, and it's more the partnership where the disadvantages and the dangers are. So I'm going to leave the sole proprietor thing alone. I don't know who I'm
Sure.
speaking to. So let's go to the partnership situation.
Mhm.
Get Albert and Walter decide that they want to set up a real estate partnership, buying a building, doing a reno and flipping it and making a profit. There are people who do that, right? Totally legal, no problem with it.
Absolutely.
Partnership to lawyers and to accountants is a dirty word. Okay, and I've said that
Okay.
very deliberately. I'm not going to tell you, more than that, but it's a dirty word. It's enough to drive anybody crazy. And the primary reasons why lawyers hate partnerships and accountants do as well is when you're not incorporated. Let's say, and I'm going to use recent experience. We're all suffering with COVID.
Mhm.
Let's say you have Albert and Walter are in a partnership of some sort, and calendar 19 was a wonderful year. And then COVID starts hitting in January or February of calendar 20, and it all goes to hell. All right. In a partnership, if you have a really good year, and we'll make it easy, Albert and Walter will assume 50-50 partners.
Mhm.
So at the end of their year, whatever their year is, they have their income, they have their expense, divide by 2, each one pays income tax as if they're an employee. There's no breaks. Okay, you're no different than a guy working, on a wage for some boss, all right? So there's no breaks in a partnership. That's one disadvantage. Another disadvantage, if God forbid Albert doesn't know Walter, or he thinks he knows him, but he doesn't know well enough, and Walter is a little bit of an operator, okay? Not in a nice way. And he manages to lie to a creditor or a lender or a supplier, and he causes a mess. The partnership is liable for that. Even though Albert wasn't involved in the mess, he gets to eat half of the damage for it.
Wow.
So there's a liability risk to partnerships. Lawyers hate partnerships. It's like anybody wants a partnership agreement. I don't want to be bothered with it. I'll turn them away. I just don't want to be bothered with it. It's just too risky, and I know the risks.
Wow.
So in a partnership, all the partners have a joint and several liability for any messes somebody else makes that they don't even know are being made. Why on earth would you want to do that? Why put yourself in that situation?
That makes me, a logical question comes to mind, Jack. Funnily enough, it seems a lot of lawyers' firms are structured as partnerships and accounting firms.
Yeah, well, yeah, but what'll wind up happening is they have limited liability corporations at the bottom. It's more complicated.
Oh, I see.
Lawyers now have LLCs that will deal with the sort of the financial issues. So the partnership part of it, like if you have Robbins Appleby, yeah, it looks like a partnership, but they're all going to have a limited liability corporation. It sibs all the way through.
Okay.
It's never that simple. Okay. But I'm not talking about lawyers, and I'm not talking about accountants.
For sure. We're talking
People
about
on the street, a carpenter, or real estate, whatever they have to do.
Got it. Okay.
Stay away from partnership. Here's another problem. Calendar 19, a wonderful year. Calendar 20, people are hanging on. Calendar 21, who knows? We're not there yet. We just started, right? There is no way of moving money around in order to maximize tax advantage. Either as a sole proprietor, which I am, because I'm by myself. I don't have anybody, my wife, but my wife's not involved in my business, right? So there's no way of extracting tax advantages out of a partnership. Whatever the net is, divide by 2 if Albert and Walter are 50-50 and they pay their tax, and they're paying it as if they were a salaried employee on a wage. Okay, there's no advantages. When you're incorporated, I'm going to move to that next. If you're incorporated, and the cost of incorporation is up in my case, because I'm fair with fees. I don't try to sort of take the blood out of anybody. It's about $1,000, lawyer's fee, government fee, and the supplies and the GST. $1,000, and you write it off. It's a deductible expense. It's chicken feed when you look at it. All right. When you're incorporated, you got 4 ways of getting money out of a company. I'm not hearing you, Letitia.
Sorry, I've got some company
okay.
Making noise.
I saw your lips moving, but no audio. Okay, we're good.
No worries.
Okay. So 4 ways of getting money out of a company. Okay. One is salary. You pay tax, whatever your marginal rate is. Not a great way of doing business. One of them is director's fees. It's like salary. Not a great way of taking money out of a company. Third one is dividends. A great way of getting money out of a company. You get tax advantages. I don't have time to get into it. There's something called the DTC, which is a dividend tax credit. You got to work with a proper accountant. And by that, I don't mean a bookkeeping service. Bookkeeping service is okay if you have a little corner store that sells bubble gum and potato chips and that's it. And the easy stuff. If you have anything that is big, money-wise, more sophisticated, either get a CPA, chartered professional accountant, or a certified general accountant, because they're all chartered, they're all certified to do tax, all right? And they'll take you through all the garbage that lawyers don't get involved in. I wouldn't touch any of this stuff because I'm not interested in it. Well, it just, you know what, if you look
Tax
at it,
stuff
it's
is
enough
not
to drive you,
much
it's
fun.
enough to drive you crazy, all right? But the
Okay.
accountants will look after all of the filings and all of the income tax and all the
Yeah.
schedules. And lawyers look at this and our eyes glaze over because for us, it's not exciting work, all right? So let them do it. They're great at it. Let them do it. You need
Sure.
to have proper accounting advice. What they do is they will maximize your return to make sure when you pull money out of the company, you get the best bang for the buck tax-wise. You can't do that with a partnership, and you can't do it with a sole proprietorship. You just can't.
Okay.
So now you know why I said, partnership's a dirty word for lawyers and accountants. So from the liability point of view and the fact that you've got no maneuverability, no tax maneuverability, there's another thing too. In some areas of activity, it may not be, the people who are watching today, but in some areas like R&D, people who do research and development, there are programs where there are grants and loans and different kinds of programs, federal government, provincial government. They don't want to deal with unincorporated entities.
Got it.
So you lose the ability to deal with these guys, the government, because somebody didn't want to spend $1,000 that they could deduct to incorporate a company.
Got it.
Practice, okay?
Got it.
Enough said about that. So what I wanted to do, because I don't want to be talking about this all the way through, is try to do a run through of the 2 sheets, which I don't know if Letitia's going to screen.
I can bring them up. I can bring them up on this.
Yeah,
on this.
I have a paper copy, and I'm sitting so far from the screen. I'm going to.
Give me a
If
second.
I get too close, and my head looks like it's exploding. So.
No worries, Jack. So tell us when this document. So today's topic is dealing, all about the shareholders agreement. Please tell us when this topic even comes into play. We're talking about incorporated business owners.
Right.
But if you're just a solopreneur that has decided to incorporate, are you even going to have a shareholders agreement or no?
If you're a sole shareholder, you won't have one because the shareholders agreement got to be A and B,
Okay.
Albert and Walter.
Okay.
Not just A.
Okay.
So the assumption is you got an Albert and a Walter, or maybe Albert, Walter, Jimmy, Mary, Bobby, whatever, right? Got to be at least 2.
Got it.
Okay.
So at the point where you've got two people, 3 people, could be multiple people deciding to set up a corporation, and maybe for the purpose of investing in a property, or maybe that could be a very common example that I come across in my network. People in my network that are real estate investors, they set up corporations or multiple corporations to own properties, potentially with partners. So
that's correct. That's right.
So let's talk about. So do you want me to scroll down and talk about kind of what's typically involved in a shareholders agreement?
All right. Well, just before we get into the what, there's another question called when. When should you do it? And the answer is early as possible.
Okay.
Okay. Preferably at the very beginning of the relationship. But what I find, and I'm in my 44th year as a lawyer, my 7th year as a judge, and I've been doing ADR, which is, the dispute resolution, for 20 years. People tend to go too fast. They get ahead of themselves. They sometimes don't know the questions to ask, and they just go. And then if disaster strikes, hopefully it doesn't, but if it does, it's, oh my God, why didn't I ask some questions? All right. So it's life. It is what it is. The when is best answered at the beginning, not when you're 90 years old and if you make it to 90. So you want to, when you start a relationship, if you're aware, and this is an awareness thing, that's why I'm talking to you about it.
Yes, and I'm really glad that you are talking to us, Jack, because I know.
That's the when, as early as possible. All right.
Got it.
Okay, the what, biographical data. Typically what goes in a shareholders agreement, my typical agreement, because I'm very direct in my language. I think Letitia knows we've dealt before, and I don't like overblown language where one of the problems with lawyers, not me, because I did journalism years ago, is they talk too much, they don't say anything, all right? I talk less and I get to the point fast, so you know what I'm talking about, all right? I was trained journalistically. I've done a lot of publishing. I've done radio, I've done television, I've done national magazines. I'm constantly writing. So I write for people to understand, not to have their eyes glaze over and get frustrated.
We appreciate that, Jack.
All right, well, just background, because, I've done a lot more than just be a lawyer for 44 years. We want to know who the shareholders are, everybody's name. Typically, of the city of Toronto, of the city of Oakville, it doesn't matter, whatever.
Fair enough.
We're going to want to know, in a corporation, you have directors and officers. A corporation's like a pyramid. The directors are at the top of the pyramid. Pyramid's a triangle, right? And a little bit below that are the officers. They're the president, the vice president, treasurer, all that kind of stuff. At the base of the pyramid are the owners. They're the shareholders. So the shareholders actually own the thing, but the directors and officers run the thing. And the directors sit above. They're legally top. Okay.
Okay.
And officers a little bit down. So
Okay.
we need all that information in order to sit with our computer and put it all in.
Okay.
We list other details, all right? Like, for example, what shares do they have? Let's assume it's Albert and Walter, and they're equal shareholders, and Albert has 1 share and Walter has 1, or Albert has 50 and Walter has 50. The proportions tell you if it's equal or not.
Okay.
All right. If, let's say, Albert has 60 and Walter has 40, it's a 60-40 deal.
Yeah.
The math is going to tell you what it is. So we need to know that. Okay.
Yep.
We need to know who the chartered accountant. I'm still using this chartered accountant. That's what it was. They changed the names around to CPA, but CPA, same thing, chartered accountant or certified general accountant. Who's going to be looking after this stuff? So you're not fighting about who the accountant is at the end of the year, because they're going to have a lot of work to do. The sharing of company records. There's a trust relationship. The English word derived from the ancient Latin, from the word fides, is fiduciary, which means good faith. You're in good faith to one another. You can't go in and be saying, I wonder how I can steal from my partner. It's not a good partnership unless you're looking for a lawsuit later on, right? But I'm assuming people are honest and they're not motivated by, negative intentions. So you're going to want to know, for example, that everybody is above board and everybody shares company records. Nobody hides anything from anybody. That's the share company records thing. You're going to want to know who the bank is. You can't run without a bank unless you're running money out of briefcases, and that wouldn't be legitimate. So if you're with RBC, what branch? If you're with TD, what branch? Okay. This is all basically bio stuff. Click, 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 and it goes in. It doesn't take long to do. Sometimes it happens that partners don't have equal capital coming in. One's a little richer, one's a little poorer. The richer guy says, look, we need to put 100 grand in. I'm Albert, I have 70 of that. Walter, you have 30 of it. I'll spot you the difference for now. I want to get going with it. But you're going to owe me 20 grand because I went 20 over, from 50 to 70 is 20, right? You have to have adjustment clauses where the contributions are off. And then maybe you add some interest from the time of the overpayment to the time that it's repaid properly. The lawyers look after all this stuff.
Okay.
So it's basically a capital shortfall adjustment clause. Every agreement I do, I have one of those in there. Maybe it's not a problem, but if it is, you've covered it. You don't fight about it. It's there. It's like a skeleton for you.
Got it.
If you want to run the screen down or up, whichever way it is, I guess up. Yeah. Okay. So we dealt with that. The last bullet in biographical is a general non-comp clause. What that means is that you don't have people who are running a business, who are running a competitive business right across the street, and they don't tell anybody. Because eventually, people will find out and they're going to have a hell of a good fight. So you don't want anybody to go there, all right?
Right. You want your partner to be loyal to you if you're going to be getting in business together.
Why would you get into this if you're going to be messing around with somebody? So it's a loyalty clause, all right? Now, there may be some exceptions, and if there are, and the clients say, look, I've got a little side business like 300 miles away, we'll exempt that because it's not going to damage this business. So far, it doesn't matter, right? But we have to be told what's going on so that otherwise we're mind readers, right?
Got it. Interesting.
Yeah. Before I move to part 2, any questions that you wanted to ask about part 1 before I move ahead?
Well, you know what, I've always, and I'm glad you spoke about the, the difference between directors, officers and shareholders.
Yeah.
So I appreciate you mentioning that, because even when I've had to form a corporation in the past, you always ask this information. In my case, I was not yet dealing with a partner, but now you're making me think,
I hope
Yeah.
I didn't scare anybody. No, look, I'm being detailed. I'm not trying to frighten anybody. I just want you to know how this
No,
is.
this the whole purpose of this webinar, Jack, is to educate my audience,
Exactly.
anybody who cares to educate themselves. And I know there are many people in my audience who are business owners or investors, and sooner or later they're likely going to face setting up a
Sure.
shareholder agreement.
Yeah.
So if you don't mind, what's the difference between what do the officers do? Are the officers what you would normally term like the C office, like the CEO,
Yeah.
the
Exactly.
okay,
President, vice president, you're gonna have a whole bunch, secretary, treasurer, general manager. Those are the typical descriptions.
got it.
They're really the doers in a company. Like the directors are legally the big shots. I'll give you an example. Sometimes when you have a retired cabinet minister or retired prime minister, and the one that I'm thinking of because he's got great connections, former Prime Minister Mulroney, that's not Ben Mulroney of CTV, that's his father, Brian Mulroney.
Yeah.
He's on the boards of directors of a lot of major Canadian companies
Okay.
because they knew he was sharp. And it's not a matter of politics. Some of them might have been liberals. He was a conservative, but they knew he was sharp. And that he knew that he added value being on the board of directors. So he'd get a salary, whatever it is. They're not huge salaries. And when board meetings would take place, the former prime minister would show up. And if they needed advice, like how do I this and how do I that, he was there for them. So board meetings are, usually have one a year. If you're a really huge corporation, like a public corporation, you might have more. But often with small companies, you don't even have a board meeting where people are face to face. I'm not talking about Zoom. They don't even meet. They, at the end of the year, you do annual minutes. It's all paper. The lawyer takes care of it. They sign off, goodbye. I'll see you next year, except they don't see anybody.
Yeah.
So a
Yeah.
lot of it is legal formality. It's not reality. It's legal formality.
For smaller corporations,
The,
but
the officers are there working every day. They're
got it.
president, vice president, blah, blah, blah. They're there every day. Those are the active guys who actually run the company,
Got
not
it.
so much the directors. But the
For
directors have to keep an eye on them, all right? They're supposed to supervise them. They're not doing crazy.
got it. And in the case of smaller companies, Jack, they could be one in the same position, or there could they be? Yeah,
Yes,
exactly.
they can.
In the
Small
beginning.
company, small
Yeah.
company, the directors and officers, same people.
Yeah, makes sense.
Okay.
Got it. So do you want to move? So I know with shareholders agreement, Jack, we also often hear the term buy-sell agreements, and I know myself in the insurance world, we get educated on that, and as per our earlier conversation, a buy-sell agreement it forms part of the shareholders agreement.
Correct.
Is it
Correct.
always included, Jack? In your experience, it's always included?
It could be. Like if a lawyer does a shareholders agreement and doesn't have buy sells in it, he's not doing a very good job.
Okay, got it.
Yeah, it's being blunt, but that's what it is.
Got it. Right.
My typical shareholders agreement, because I don't like things that go on and say the same thing 55 times and the client gets to pay for, retyping. Because we work off formats that are on our computer and you bang away on them. My typical agreement runs maybe 15 pages, maybe
Okay.
17 if there's some unusual stuff.
Okay.
The average one, not longer than that, because you're going to cover off what you need to know in that, unless you keep saying the same thing 65 times, right?
Got it. Okay.
What's the point? Why make people, spend money for nonsense?
Got it. So I have heard that sometimes they're not properly worded.
That can be a problem too. Yeah.
So
Let me go to the text so we don't
sure.
get way late on it because time
Got
marches pretty quickly. So we're at part 2, buy sell clauses.
Mhm.
Okay. 3 things to know. Okay, and I've divided them up when I ran this little checklist off first thing this morning. There are what are called lifetime buy sell clauses. That's part 2. What are lifetime? You're getting older, you want to retire. Albert and Walter, who started the partnership, I don't want to use the partnership, the company, when they were in the 20s, are now in their 60s, and they're starting to think, how many more years am I going to do this? Maybe, we want to sell it to someone else or whatever, right? So, or they're starting to fight because people don't all grow at the same rate.
Yeah.
Right? It's a little bit like a marriage. Husbands and wives don't always grow at the same rate and they separate. So sometimes in a business, one wants to do one thing, one wants to do another. There's all kinds of crazy stuff that happens. A lot of business disputes that start looking like family disputes you get Albert and Walter are bachelors. Albert marries somebody. Walter's still a bachelor. Albert's wife is the wife from hell insofar as Walter's concerned. And the wife is instigating between Albert and Walter, who always got on great with one another. And eventually, either Walter buys out Albert or Albert buys out Walter. It happens. It's
Wow.
sad, but it happens.
Wow.
Lawyers are the ones who have to listen to all this stuff, right?
Oh my goodness. Wow.
Yeah. Yeah, and they can't send them to marriage counselors because they're not spouses; they're business partners. So we get all the wonderful stuff we have to listen to, right?
Wow.
And
I
then
never
try to
thought.
counsel people as to how to get out of it.
Wow.
Your lifetime buy-sell clause could be because of conflict. It could be just aging and you want out. You don't want to do it anymore. Or
Yeah.
you want to get out of that business and do something else.
Yeah.
So you have to have a skeleton for that. There's two types, okay? We're at part 2.
Yeah.
Lifetime buy-sell clause, shotgun or offer to third party. Offer to third party basically runs this way, that somebody wants to sell, and they're talking about it amongst themselves. This is not Putin running Russia and it's a dictatorship. This is, so they're talking about it. And whichever one, Albert or Walter, wants to sell, and he's got somebody who's interested in putting an offer in, so that either Albert goes or Walter goes. So we can structure it that way. The problem with open-ended negotiations is they can drag. I have the last little bullet at the end of part 2 is timing.
Okay.
Why did I put timing down? It can go faster, it could go slow.
Mm-hmm.
It just depends on whether people are dragging.
So
Or
what's
some-
usually, pardon me for interrupting, Jack, I mean, what's usually done? Is there a business valuation done? What would typically be done, first of all, to determine in the event that it's one of these
fair market value.
fair market value?
I'll get to that more later, but the
Oh.
simple answer right now is not usually. When you're dealing with people who are alive well and they're okay up in the,
Mhm.
in the up here,
Mhm.
generally they have an idea already what the market value is. They're not running around to valuers, in my experience. Where valuers are important, if somebody drops dead on you and you've got, the spouse, the surviving spouse of somebody who's died, who doesn't know a damn thing about the business,
Yeah.
and all of a sudden they have to get bought out, they're going to say, what do I know about it? It wasn't my business. It was my dead husband's business. So usually if there's death or major disability, I'll come to that later, that's when you want a valuation by a professional.
Got it.
But the lifetime stuff, normally people, if they have some clue as to what's going on, they know the range, low and high, they know where they are.
Yeah.
That's
Yeah.
the simple answer to your question.
Got it. And that's something that it's part of the negotiations that even someone like yourself
Yeah.
could help clients with, to come to terms with,
Exactly.
this is, you've got this properties together, this is the market value,
Yeah, whatever.
you're
I
going
mean,
to
they have
sell.
to figure this stuff out, right? But here's the bottom line. The trying to sell off to a third party can be difficult timing because one person could be really efficient. People are people. We're all, function differently.
Oh, yeah.
Some people, they get out I mean, I had a client years ago who came to my office and he was complaining his feet were cold. I said, did you notice you didn't put your socks on when you put your shoes on? He had no idea. He had a PhD. That doesn't prove anything either. So, cute little joke, right? It's a
Hi.
PhD who doesn't put his socks on in the winter and complains his feet are cold. It's an interesting world out there. Anyway, so leave that aside. Yeah, I didn't intend that as a joke, but it's so silly that it's ridiculous. Anyway, so one of the problems with going out to an outsider is it could take longer. If, rather than you hope to get the deal made in a month, maybe it's 6 months. You may not want to wait that long, right? So what a lot of people do is they go shotgun. That's the second line of that first bullet. Buy-sell clauses, lifetime buy-sell, shotgun. What a shotgun is, either Albert goes or Walter goes, but you got time limits and you don't go on forever with it.
Okay.
Right.
So that's a
that's
clause that would typically be
Yep.
included in and what's a typical time frame, Jack, out of curiosity? Do people say,
30 days, no more than 60. You don't want people arguing and arguing. Here's the problem. If the time gets away from you and if there's any conflict going on, what damage does that do to the business?
right, very
Rather
interesting.
than looking after their business, they're busy smacking each other around. It's not good for business.
Wow.
So there's a business purpose test that's hidden. It doesn't say that, but if you think about it logically, that with a shotgun, whatever the hell happens, it's over with fast. Okay.
Got it.
You don't
Thanks for
want to
sharing.
impair the business because these guys are busy yammering back and forth.
Got it.
My,
Interesting.
my preference is shotgun.
Got it.
I like certainty, and I like certainty quickly, not, we'll talk for the next 16 years. In the
Got it.
meantime,
But then, Jack, obviously the party that leaves, or rather the party that buys out the other party has to arrange some sort of financing, or they have to have the liquidity, or they have to come to an agreement as to how they're going to manage buying out the other party.
What happens is in the agreement that we prepare, we have those financing clauses with time elements in it. It's all in the agreement that we do.
Got it.
And
And
again,
that happens at the point when essentially it comes time to execute the buy-sell agreement, correct? In other words, they've come to the point.
Remember the when? At the beginning. Why? At the beginning? Because if you're fighting later, the odds are you won't agree.
Oh, okay.
Logic to all of this. It's
Oh, really? Okay,
Yeah.
so in the buy-sell agreement, you would even specify what type of financing would be provided to the buying party?
Not what time, but the timing to get the financing. Because you don't
Oh,
know
I see.
what banks are, but you're going to have a time sequence saying that once the deal is in place, the buyer shall have 90 days to arrange his financing to be able to close, at which time all the documents will be executed and each one will have a lawyer and blah, 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 all that stuff. Okay?
Okay,
All right.
great. Thanks for clearing that up.
Yeah, and that's all in the shareholders agreement, and the when that I started off with, when timing, as early as possible. People don't fight at the beginning of a relationship. If they're going to fight, it's into the relationship where they realize, well, it's not what I thought it was.
Yeah. Yeah.
It's almost like marrying the wrong spouse, and 20 years later you find out why did I do this, right? So it's the way it is. People are people. We're imperfect. So
yeah.
When these kinds of arrangements are great, they're great. When they're not, they can be hell on earth, right? So
but that's why you want to, as much as
that's why you
possible,
want to have
set things
all
up.
this stuff pre-agreed at the beginning and don't fall into a mess later on. All right.
Amazing. Yeah.
Okay. I'm going to go to the next
Yeah.
little one. Again,
Let's go.
I don't know where we are on time. Yeah, we're a half an hour and a bit past that. Okay. I'm okay on time. It's just I don't like people, dragging on. If an hour is all they can take, I don't want people.
I appreciate that. Thanks, Jack. So tell us more about these piggyback, drag along. What is all this?
Yeah, what that is that's in a minority shareholder situation, where a minority shareholder, let's say, has 15%, and the majority has 85%. And the majority says, you know what, I want to get rid of these shares. I want to sell them out to somebody. So the minority says, hey, I don't want to be stuck here alone with a new shareholder, partner, but shareholder. I don't know who he is. I don't know who you're picking. So I want a piggyback clause, which means if you decide to dump out, my shares get sold to that third guy as well. That's piggyback. You piggyback on the major guy going
Okay, good to know. So that's something that protects minority shareholders.
Exactly. Yeah, strictly. Because there's, 85 is up here and 15 is down there and whatever.
Totally understand. Cool.
Drag along clauses. That's where, same thing, the majority wants to kick out to a third party, and the minority is sort of, I don't know if I want to go, and the third party doesn't want the stranger with 15%. So the majority has the power to drag him along to dump out the third party. So in one case, the minority wants to piggyback. In the other case, he doesn't want to. He has to be dragged along.
So you would have both. You would have phrases that account for both possibilities.
Well, you'd put them in. Yeah, you can. Yeah.
Interesting. Interesting. And that's something owners have to agree to from the beginning, because this is a typical scenario.
Do it early so you don't fight later on.
Interesting. So this is a typical scenario that can happen where we have a minority shareholder. Either they want to go or they don't want to go.
Sorry, you'd probably either do the piggyback or drag along, because when they're negotiating, the little guy is going to say, look, I don't want to be stuck with my shares, not knowing who those new characters you're bringing in. I insist on a piggyback clause. And if it's there, it's done, finished. It basically control 100% all goes out to the new guy, and then all the old guys are out. And that's it.
Okay. And Jack, this is a question that I should have maybe asked from the beginning, because I'm used to, for example, real estate transactions where the buyer has his own or her own lawyer, and vice versa. The seller has his own lawyer and her own lawyer. Right. In the case of a buy-sell agreement, is there only one lawyer that works on it typically?
It's a good question. That's not something that I put in the material. It could be either. Okay. If the parties are trusting of the lawyer and they know the lawyer is being honest and neutral. In other words, he's not taking sides, taking advantage of anybody. Mm-hmm. Usually the client will come to one lawyer. And the
Okay.
other side will know that. And then if they're prepared to say, yeah, I trust whoever the lawyer is, Jim Smith, right? And I waive my right to independent legal advice, the waiver will go in the contract. That's really to protect the lawyers. It doesn't look like he forced somebody to do something when he didn't, right?
Okay.
But if they say, no, I want to take this to my own lawyer, great, fine.
Okay.
And
And
the
then,
answer to this, it could be the one, it could be the other.
okay. Thanks for explaining that. Okay.
Okay.
The timing,
Time-
you already spoke about that.
Yeah, we talked about that. Timing of a shotgun could be as little as 30 days. Albert goes or Walter goes, and maybe another 60 for the one or the other, whoever is buying this thing out, to go get his financing in place. Optimally, what I've had clients do is agree to a 90-day frame from the beginning to the end. 30 to negotiate, get a result with this thing, get finished with it, and another 60 to get the financing. 30 plus 60 equals 90. It
Got
doesn't
it.
have to be. Just a suggestion. Doesn't
Yeah,
have to.
that's
There's no law saying it has to be that. Could be
that's a
shorter, it could be
reasonable.
longer, right?
Yeah, I get it. But I mean, just somebody saying, well, you know, Joe, I'm thinking of getting out. Just saying that you're thinking about it is not triggering the
No,
clause.
no,
Like
you
you have.
Yep, yeah. Somebody would have to make an offer saying, look, I want out. Here's my offer. It's all in the agreement.
Oh, I see. Okay, got it.
All
Okay,
in the
thanks.
agreement. All
Okay,
that language is covered in the proper shareholders agreement.
got it. So interesting.
There's nothing left to chance in this stuff.
Yeah, amazing.
The trick is not to rewrite the Encyclopedia Britannica, but to keep it nice and short, so it's 15 pages, and it's all in there, and you don't drive people crazy reading a bunch of garbage that nobody wants to read anyway.
All good, all good. I mean, this is a great, really great overview, Jack, and I bet you, you know, unless somebody's already put together a business partnership, but I mean, it sounds to me like it's not mandatory, or is it? Like when you have two people forming.
It's not, but it should be. But you know what? The law doesn't always force people to do things they should do.
Absolutely.
One of the things I know as a lawyer and as a judge is the law sets minimum standards of human behavior. If our laws, we'd probably have a revolution if we went maximum, all right?
That's
No,
true.
you will do this, you will do that.
I mean, look what's happening now in Toronto.
Like in the States where they didn't like the results, so they figured they were going to go, you know, start shooting people in Congress on January the 6th. There are people that function in that vein, right? So the law usually sort of makes minimal expectations of the minimum things that we have to do as a civilized society. And, you know, if you start levering those up, some people say, no, I'm not going to live with that. And then some get violent. So what are you going to do?
Got it. So
the world's an interesting place, right?
No, that's very interesting, Jack. So in other words, you as a business owner, if you're going to bring a partner on board, you know, ideally your lawyer should be telling you, you guys need to have a shareholders agreement. Absolutely. And now anybody who's listening and is contemplating incorporation or is already working with partners and maybe they don't have a shareholders agreement,
they need to be thinking about it.
Absolutely. And so that's why I'm really glad that
I do this work on a regular basis. I have all of my precedents stored in my computer, you know, it's all in my hard drive. And once I know the broad strokes of where people are going, I pull something that's as close as possible. I have agreements between Albert and Walter, not their real names. I have agreements, 5 people involved, okay?
Got it.
That are much more complicated with these, you know, these piggyback and drag along clauses. So I pick an existing file that's close enough to where I am right now. I say, okay, that's probably, and then I tinker, I fiddle around with it in order to get it where it has to go.
Got it.
And the rewrites. Okay,
let's
leave that and go to the death clause, part 3.
Yeah.
I'm trying to be mindful, it's 20 to 5.
Yeah.
I'm okay on time, it's just I don't want to go over people who, it doesn't work.
No, thank you.
All right, with the death clause, again, it's in the Bycell. Somebody dies who's a shareholder, Albert or Walter, the estate has to sell their shares. They can't stay in. Who winds up buying the shares? You know, the estate. We'll assume it's the wife, right? Assume Albert and Walter, they have a wife. So the wife of the deceased Albert or Walter, whoever, they must buy the shares, and the estate must sell. Okay, it's a mandatory transaction. There's no maybe I will, maybe I won't. It's got to go on that way.
Yeah.
In a case like that, you don't want people negotiating fair market value. It's not fair. You know, assume Albert, you know, drops dead all of a sudden, and Walter is, you know, in a rush to pay off the estate of Albert. And Albert's wife says, I don't know anything about this business. I was never involved. I stayed home. I know zero. All right. How do I know what fair market value is? What I've done different things, but what I've done is said, look, why not appoint in the agreement I'm doing the chartered accountant or CGA, whoever their accountant is, to act as the valuer, because they're numbers people. And whatever they say fair market value is, you pre-agree that's what it's going to be.
Okay.
And because the accountant is neutral to the two of them, he can't tip it one way or tip it the other. He's going to go right up the middle. So you'll probably have a
Right.
very fair result.
It would typically, so would it typically be the same accountant that typically services the business? Would it be the same accountant that
Yeah,
usually?
it's probably easier because he knows the business better because he's done their financials. Does it
Absolutely.
have to be? No, they could pick somebody else if they
Got
want.
it.
If somebody else doesn't know anything about it,
Yeah,
probably take longer for them to figure out what's going on.
got it.
It's
Got it.
easier if they're going with the guy they, as long as they're not having fights with them.
Sure.
We'll say him, or whoever it is,
I
right?
mean, and of course, the agreement could be updated later on if there's a change in accountant or what have you, right?
Yeah, you can always amend an agreement if you get some brainwave, you want to do something. As long
Yeah.
as everybody who signed the original one says, okay, we're changing A, B, and C, fine.
Yeah.
Knock yourself out.
Got it. So
Okay.
so let's talk about what happens in this case. So in other words, the accountant would agree to, hey, this is what the market value is.
Yeah, issue a report to both of them, right?
He
He'd issue a report.
It will issue a report, right? And based on that, so now the surviving party is in a situation where, and I know about this a little bit because in the insurance world, we get educated about this. What happens when one of the partners passes away? All of a sudden, the other partner is technically now in business with a surviving spouse of the or surviving children. There may be people that have no intention of, or may know nothing about the business, and it's not an ideal situation. So would you?
Let me deal with that because you said something that actually doesn't quite work that way. So,
Okay.
So one of these guys drops off, all right?
Mhm.
And in the meantime, the estate, the survivor rather, has to come up with the cash, right? Have to pay the purchase price.
Yeah.
Price set, it's the accountant, this is the price, that's the end of it all. You don't get the family running the company. The survivor for the time being will run the company.
Yeah.
No wives, no children, none of that stuff, because they're not involved in it. They never were, they aren't now. The only holdup is getting the money transacted so that the dead guy's estate, sends over the paperwork and the live guy pays the money and they shake hands and they move on.
Right.
So that's a timing issue and a financing issue,
Yeah.
which segue, because you mentioned it, the absolute importance of having life insurance. Unless there's a nice big rich bank account that Albert and Walter have, because maybe they had a rich father and the rich father wrote them really big checks,
Yeah.
they never use the money and it's sitting there. Okay. And there's enough there that you don't have to worry about it. Most people don't have that kind of pile. And hopefully, I don't want to get into insurance issues, but hopefully at the point that the life insurance is purchased, that they're young enough, that the premiums are not sky high. I know because I did a lot of work with insurance people over the years when I was in active practice. I semi-retired 2 years ago. Once you hit age 41, it's like a rocket ship taking off, right? The premiums really jack up, quite radically compared
More
to,
so for men versus women, and depends on the type of policy you put in place.
Yeah. But it can be a problem. Age, obviously, if you're buying term, I just came off a 10-year term, bought it at 61, renewable at 71. I'm 71 now. My wife got the renewal notice. The premium went up 6 times. I said, I don't need that insurance anymore. I canceled it.
Yeah, you may not need it anymore, or you may want to do what's called a conversion to a permanent policy.
I didn't even want to bother with it. I looked at the premium. I got plenty of stuff put away. I didn't need it. I said, you know what? Tell the agent, cancel. I had it all these years. Goodbye. It's done. That was it, right? So what happens is life insurance, that's not for me to get into, but in your case, because it's part of what you're doing, absolutely critical. It should be done as a corporate asset, a corporate owned policy. Because you can insure, Albert could have a policy on Walter and Walter crisscross.
Yeah.
Crisscross. And stay away from that. You want the corporation to have it. And I'll tell you why in a second, because I'm getting to that. God forbid one of these guys pops off. Insurance company, there'll be a form that has to be filled out and death certificate, all this wonderful stuff. The insurance company will pump out the money. It has to go to the corporation.
Yes.
The surviving director, officer, shareholder will convene a whole bunch of meetings. They have to, and they will then say, okay, they will have the accountant. This is where their accountant comes in. Record the money, all right? in something called a CDA, which is a corporate dividend account. Okay.
Yeah.
CDA.
In other words, the life insurance payout gets paid to the corporation because it's a corporately owned policy, and it flows through this thing called the corporate dividend account. It's a nominal account.
Yeah,
that
it's basically a fiction, but the purpose
That's
behind it is it's one of the 4 or 5 things that are capital gains tax free.
exempt. Yeah.
Yeah. So it's got to go the right way. And when it goes through that, it's out of that money, all right, that the person who is running the estate of the deceased, you know, gets their money, and the surviving Albert, Walter, whichever guy it is, they're done. Okay. They do their transaction, shake hands, goodbye, and that's the end of it all.
In other words,
So-
the life insurance policy provides liquidity to the surviving shareholder to
Correct.
buy out the shares of
Exactly.
the
Yeah.
shareholder that just passed away.
'Cause they may not have a rich father where they stuck money in BMO, and you know, 25 years later, oh, I'll go into that bank account and I'll cash my certificate.
More often than not,
everybody's
people
in that
don't.
situation.
Yeah.
You need insurance. The corporation has to own it. It's got to find its way into the CDA account, all right? And that way it's sourced out properly, and you maximize your tax advantages, because that money, that insurance money, is all non-taxable.
That's right.
It's one of only about 4 things in Canada that's not taxed for capital gain.
That's right.
So absolutely important not to have it running in some other direction. I saw a terrible agreement. I'm just looking at my watch. I saw a terrible agreement that I could do nothing about. It was a client that I'd not seen in a number of years. He had another lawyer, he just wanted my opinion. And I looked at it, I said, this agreement, shareholders agreement, was screwed up because nobody plotted out insurance with the company through the CDA account. You know, money released as a dividend, all right, because you have to dividend it out, and then across to the estate. They didn't do that 1, 2, 3, 4. And I said, there's a risk that CRA may come in and audit this, saying this is a capital gains transaction as opposed
Wow.
to tax free.
I see, because the benefit was going, personally to the shareholders, to the surviving spouse or what have you.
They didn't do what they had to do. And when he walked out of my office, he looked like he wanted to cry. This guy was an engineer. He didn't know anything about this stuff. Why would he as an engineer? He builds buildings, right? So I said, I got bad news for you, but I'm not going to be dishonest. The agreement that was signed, it was his son who had passed away, right? So the father was the executor for the son. The son had died unexpectedly. I said, you could have, if CRA gets wind of this, unless somebody picks up the phone and snitches or they do an audit, they might never find it. But I said, but you don't know. If they spot audit and they see that the 1, 2, 3, 4 wasn't done properly, they'll, capital gains, they'll do a notice of assessment.
Right, because the owner, it sounds like the owner was the corporation, but the beneficiary was set as a person outside of the corporation.
Yeah. Well, actually, worse than that. The insurance company was TD Insurance.
Okay.
The lender on a line of credit was TD Bank. TD Insurance just sent the money to TD Bank. The whole thing was screwed up. They really made a mess.
They're protecting their assets.
Their interest, but they didn't protect the interest of the estate.
Wow.
I mean, I don't know, I'm not involved in it, but that could have been one nice lawsuit against TD for mispaying the money. It should never have gone that way.
Wow.
Totally.
Right.
And so I say the father of, bad enough he lost his son, I had to give him more bad news. So he looked like he wanted to cry when he left my office. Anyway, let's leave that for now.
Yeah.
Part 4. Because we're getting
let's talk about so just to sum up here, in order to facilitate the buyout clause in the case of one of the partners, passes away unexpectedly, life insurance can facilitate the buyout clause. In other words, provide liquidity to the surviving partner to be able to buy out the shares. And in those cases, Jack, do you still apply typically the same 90-day timing, or does the Bycell agreement, even in those cases, in the case of death, for example, does it also specify, okay, within how long does the surviving
usually you do. Now, one of the problem, if you have insurance, if the people are insurable, Albert and Walter are insurable, and they do what they're supposed to do. Yeah. And the insurance company immediately has a claim on the insurance. Yeah. Insurance doesn't take forever.
No, they're very fast.
They're very fast. Right? So usually, 90 days, 100, it's usually more than that.
Way less than that. Yeah.
Where the problem could be is if there is no insurance.
Yeah.
All right. And Albert, we'll assume Albert's the one who lives, right? And Walter pops off. Where Albert gets the money from could take more time. They might have to sit and negotiate an extension at that point and say, look, guys, I can't do this in 60 days. I might need 120. And hopefully, you can do what you can do and you can't do what you can't do. It's called life, right?
Got it.
So you do the best you can.
Got it.
You try to keep to a time frame. If
Yeah.
you needed an extension, you in writing, okay, we're going to extend it in order to give Albert the extra time he needs because we don't have insurance. We never bought it foolishly, but people live with the decisions they make. Sometimes they make rotten decisions.
Mm-hmm.
Okay.
Well, they just don't know any better. They were
Or they
not
don't
well
know. They don't know how to
advised.
ask.
They were not advised. Yeah.
It's the analogy I use is somebody who doesn't ask questions gets into a car, has a face mask, not a COVID mask, right? The COVID covers your nose and your mouth, a whole face mask, right? And he decides he's going to get on the 404 and drive like hell until he hits the first post. You got to watch what you're doing, and you got to know who to go to, when to go there, and ask questions.
Yeah.
Okay. I mean,
Awesome.
that's called life.
Got it.
All right. So major disability, number 4. We're actually doing very well because it's about 10 to. I don't care about timing, as I said. I just want to hold people back.
Thanks, Jack.
There's a third type of buyout, which is major disability. Somebody has a stroke or they meet up with a terrible accident. They're racked up. And let's say they're not going to get back to work for a minimum of about 30 days or so. Okay.
Oh.
So there will usually be a grace period saying, up to 30 days, no buyout. After that, the people who are healthy have the option to buy out the guy who is all racked up. Okay. And then the racked up guy, the injured guy, whatever's happened to him, must sell out. Again, neutral share valuer, because you could be the guy who's messed up, could have had a stroke, maybe his brain's not working. You don't want to get into a fair market value debate with somebody who's not doing well. It's not the same thing like death. I use the same format. Give it to the accountant. The accountant knows what's going on. Low number, high number. The middle is in the middle. That's it. Okay. Which takes us back to my favorite subject. Use of insurance for funding.
Yeah, interesting.
So again, there are special kinds of insurance to assist with the disability buyout. I'm not going to get into detail on it, but there's a product there.
Disability insurance.
It's not cheap.
Okay.
But the younger you are, the less expensive it is.
Yeah.
I can't speak to whether premiums for men, I don't know. It's your field. I don't follow stuff like that. I know it ain't cheap. Okay. So, and then timing, of course, the same issue that we talked about before. You don't want things dragging because in the meantime, the company has lost a critical person through illness. You want to move this as fast as possible. Keep shorter time frames. If there is this insurance and everything's legitimate, there's no fraud or any nonsense like that. Well, money usually flows pretty quickly.
Right. In other words, if you have a certain type of insurance, it could be potentially critical illness insurance, or maybe a combination of disability and critical illness insurance. If it provides funding to the corporation, it would again be able to facilitate the buyout of the party that is no longer able to work in this case.
Okay. This is a nutshell of what goes into our agreements. All I was trying to do here in the hour is give you an overview of the really important stuff. We deal with all this when we're sitting at the computer banging away. It's all in there. It'll be in there somewhere, right? This is just intended as an overview so people who are not familiar say, wow, I didn't know that. And that's interesting, right? And then hopefully they'll do something about it.
Yeah.
Number 5, which is
So go ahead. What I wanted to do, Jack, I just wanted to get your contact info and copy it and paste it in there.
Okay. One last thing, and then I'll do that. Number 5, part 5, I think you have it scrolled up. Miscellaneous, non-comp and non-solicitation. One side's gone and the other side is staying there. I don't care whether it's lifetime, it's death or disability. Somebody ain't there anymore, right? So you want to make sure the person who's gone out, especially if they're alive and they've gone out, are not going to set up a competitive shop 2 streets away. Because if you sell business, you can't steal it back. I had a client, sad to say he was in the insurance business. I had a client who was very, he was a really hard worker, but he was really impulsive. I think he suffered from ADD. Like he couldn't sit still. He was always jumping somewhere, right? I liked him, but I knew what he was like as a person. He passed away, had cancer. He died about 3-4 years ago. He had a Bycell agreement, and the fatal mistake that he made, and thank God I didn't do the agreement. He had some other lawyer do it. I don't know why. Where he gave an either or choice in the lifetime part of it, that he would make an offer to buy out the other guy's shares, or big or, the other guy could force an offer to buy his shares. So it's or I sell or you buy me out,
Oh,
right?
so you're like
Or
in
I
this
buy you out.
conundrum.
Yeah, it was silly. I don't know what lawyer thought of it. It was stupid. He came to me to close the deal, and I didn't act for him for a while. And I said, what did you do? He said, well, I triggered they weren't getting along. Okay. And the not getting along was he had a daughter who was a very good sales lady with a real nasty mouth. And she
Mm.
didn't like the partner and she was busy yapping around the office. And that split the two boys up. In this case, it wasn't a wife with a yappy mouth, it was a daughter with a yappy mouth.
You're making
And
women sound so bad,
no,
Jack.
no,
Come
no, I'm
on.
just telling you, it's what happened. All right. It could have been a
Fair
yappy
enough.
son. It just so happened the daughter was a
Yeah.
really good salesperson, but she had a very strong personality. And the other guy, the other partner, was very quiet. He did not like to fight, but he was burning. Okay. And at a certain point, it's not working anymore. And it was too bad because these guys were actually related. They were half brothers. One of their
Yeah.
parents was the same, and they had been so close. It was a very sad breakup. Like I knew the family, and it
Wow.
was really sad to watch all this. Like it's just the personal dynamic was awful. These
Wow.
things happen, right?
Yeah.
So at the end of the day, the fellow I was acting for wound up selling a business he really wasn't ready to sell. He didn't see the
Wow.
trap he was walking into. He didn't see that the other guy had the money to do the closing. He was so sure of himself. Well, you know what? Never be too sure of yourself, right? So he didn't foresee that the other fellow, right,
The
would
quiet
be able to
fellow?
buy him
Hold
out.
on.
Yeah, the partner.
Don't tell me. So he thought he was gonna make an offer and let me get this straight. So he thought he was gonna buy out his partner, but in the end, what ended up happening?
Exactly. He flipped it on him, worked the other way. You
Oh,
got it.
wow. So did his partner make him a better offer than what he had
No, no,
offered?
no, no. It's identical offer either way. What my fellow didn't know is that the other guy had a backer. He didn't know that. He's
He
too
had
sure.
he had a backbone, you
Yeah,
said?
a backer, financial backer.
Oh, okay.
And he
Yeah.
didn't realize the other guy had access to money, not his own, borrowed. But my fellow didn't realize the other guy had a financier. Same offer.
Got it.
So
Got it.
as a result, he sells when he doesn't want to. I was there just to do the closing. A month later, he's back in business and he's calling up all the customers
Oh,
who he wasn't supposed to touch
oh,
because they had a list. Don't touch these people for 2 years. He breached. He knew he breached.
yeah.
He did it on purpose. You don't have to be a rocket scientist to figure this stuff out. So that's what wound up happening. And that precipitated 10 years of litigation.
Oh
I
my
acted for my
goodness.
fellow for 10 years. The other guy was really angry. And 10 years, both sides, it eventually settled. And my fellow had to pay him out a certain amount of money. But the money that he grabbed by doing what he shouldn't was the amount of the judgment. We had a 7-day trial
Wow.
and 10 years of lawyers banging each other around.
But so in other words, your own client was the one that messed up. He was the one
My guy was the bad guy in this piece. Yeah,
because he
I had the bad guy.
you can't control people's behaviors.
No, you can't. No,
You
no.
didn't expect he was gonna do that.
If he had come to
Wow.
me, here's the part that was sad, okay, before we went. If he had come to me, because he hadn't been using me for a while, he was running around with other lawyers who he didn't even know. But they knew each other as a lawyer and also socially. Okay, so I knew what this guy was like. And I knew he was very impulsive, like rush, 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 rush. Just sit down, stop rushing so much.
Mhm.
But what are you going to do? If he'd come to me at the negotiation stage, and if he had told me what kind of agreement he was going to sign, I would have told him outright, you're crazy, you're nuts for doing this. Because God forbid your partner, if he has the scratch, he has the mullah to
Yeah.
buy you out, you're gone and you will have sold the company you didn't want to sell. I know he didn't want to sell.
Wow.
So I said, so, if he had checked with me on that, I wouldn't even have billed him for that advice. Like, what did that take me? 10 seconds to say it?
Yeah.
You don't bill for 10 seconds. So I was really upset with him that he didn't talk to me about it because he knows that I'm a straight shooter and I would have told him, don't go near me. If you're gonna look at something, it's got to be controlled enough, all right? Where this guy, where he's selling out to you just the one way, not both ways. But anyway, he signed a crappy agreement. He gave away power, and the power was used by the other fellow to kick him out. That's basically simple English. That's what happened. Followed by theft and 10 years of litigation that ultimately had to be settled because my guy was the bad guy.
Yeah.
You can't pretend to be an angel when you're at the other end, right? So it's
So they did have the non-compete clause when in the
Yeah.
agreement.
Oh,
And
better than that, they not only had a non-compete, they had a listing of all the clients who were not to be touched. And he went and touched anyway. So I said to him, I said, what do you want me to do? Float on air? I mean, no lawyer can deal with that.
oh man, wow.
He made his own mess.
Yeah.
And he got to pay for it, but it took him 10 years to get there.
Oh.
Now, the only thing is, he made a bundle in the meantime. So he may actually have profited from his own, I don't want to use the word crime, but he may have profited from his misguided behavior, because by the time he had to pay off, the settlement wasn't all that high compared to what it could have been. The court was nice to him. The judge was, we had a trial, 7 days, not full days, but the judge was nice to him. She didn't hit him as hard as she could have. So I did my job well, but he could have avoided it if he had just got proper advice at the beginning and don't be in such a rush to go, you know.
Wow.
His rushing was his undue.
Thanks for sharing all that. That's
interesting.
Yeah.
That's the one story, and this was a horrible. It was an awful story. So ultimately, he died of cancer. He lost his wife to cancer, and this stuff didn't help her. She was dragged into it some years before.
Yeah, I can't imagine.
Family, so it
10
was
years of, yeah, I can't imagine.
You know, it's one of those stories that leaves you just shaking your head and you're sad afterward, because you know the people, and you're saying, you know what, this pile of garbage could have been avoided.
Of course.
But he was, I think he was ADD, everything fast. He doesn't bother asking any questions, or at least didn't ask the right ones.
People make sometimes questionable choices, you know.
Okay.
And again.
Yeah, you got my contact information.
Yeah, I wanted to put that up, Jack. And obviously this is an area that you have expertise in, and even though you said
doing this for a long time, so
yeah, and you're still practicing, and now I was going to ask you, Jack, in these days of you know, everything remote, do you, just as I asked you in our conversation related to wills, powers of attorney, which you also do for people, are you able to do these types of agreements remotely now via Zoom?
Okay. We're using
Okay.
You know, for signing a shareholders agreement, there's no requirement that we have to be the witness. So you could just grab, you know, Jim Dokes as a witness. Let's say your name is Albert and Walter and somebody else, and Jim Dokes is your next door neighbor. He could act as a witness.
As long as there's another witness.
Wills and powers of attorney, it's more regulated, so we have to see the Zoom signature, or they get somebody else. I've done that too, where they have a friend who lives next door with the mask and the whole deal. They look after it, and we don't have to start with the zooming back and forth, right? There's always ways around that. If you're creative, you can find
Got it. So everyone, if you're listening to this, and if you're in a situation where, you know, maybe you formed a corporation already, or you're contemplating forming a corporation, Jack is somebody that can definitely help you set this agreement up properly, so that both you and your partner or partners are protected, and you're not going to have surprises later down the line. When things may go maybe not as well as you anticipated from the beginning. Life happens, and it's best to protect yourself, protect your assets, and also have clarity in your business relationships. So thanks again, Jack, for this, you know, very educational session. I really appreciate it. I'm going to share this particular webinar on a few of the real estate investors groups that I'm a part of, because I feel like this would be very useful. And even once I upload it to YouTube, you're welcome to upload it on your LinkedIn as well. I really appreciate it. And of course, if people, once they're at the stage of setting up the Bycell agreement, I'm also happy to help with the insurance side of it. In the future, I will probably have more specific insurance related webinars for business owners. I've done some in the past, but it's kind of about time I do another one. But suffice it to know, I'm also available. Feel free to reach out to me over Facebook or LinkedIn, Leticia Montana, and I'll put my email address in there as well.
Okay.
Perfect. Thanks, everybody. Thanks for watching. Jack, thanks again so much for your time. And I look forward to staying in touch and continuing to support.
We can do this again, you know, whenever you want. No,
I'll be more than happy to, Jack. It's been very helpful and educational. Appreciate it.
You take care.
Thank you.
You're in sunny Mexico. I guess it's sunny. I don't know where.
It is.
It's 4 degrees today in Toronto. The snow is gone. They're predicting maybe a little bit of snow flurries.
No, that's
But
pretty mild for
yeah,
middle
it's
of January.
it'd be nice if we had some blue sky. Unfortunately, that's too much to ask. We're getting gray sky, so what can you do? It's the way it is. So
I know.
today
Okay,
was the first day the COVID numbers actually showed a very good drop
I'm
in
gonna
positivity
just,
for the last 10 days. We got some good news today, which we haven't had for a while. This is Ontario's numbers.
that's,
So I was pleased to hear that. Yeah.
well, I'm also happy to hear that. I mean, considering
I know.
all the lockdowns, everything that's been happening,